AT&T is buying TimeWarner. We think. Should AT&T investors celebrate or fear this deal? What are the chances of the deal making it past regulators and becoming a reality? We talk debt, we talk free cash flow, and the power of content on today's show. Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Investor in the Family Radio, we believe that you can become a great investor. How? By building the right plan and then sticking to it. According to Warren Buffett, that's what it takes to set yourself apart. And everything we do here is meant to help you get there. So thanks for joining us. And a special thank you to everyone for your patience for my voice today as I am recovering from a recent cold. You can always find more at investorinthefamily.com and subscribe to the podcast at iTunes, Stitcher, and the Google Play Store. And if you'd like to join me on the path to becoming an intelligent investor, simply text the word Join Family to the number 44222. That's Join Family, one word, to the number 44222, or visit investorinthefamily.com and sign up, and we'll make sure to take care of you so you don't miss a thing as we work to become better investors together. And I hope you enjoyed today's interview with Adam, the Dividend Sensei. Well, hey, Adam, welcome back to the show.
Thanks for having me on, Brian.
Absolutely. Well, today I thought it'd be really fun if we spent some time talking about AT&T. AT&T has been in the news a lot recently, obviously, with their hopeful acquisition of TimeWarner. But do you mind just kind of give us a little bit of a background on what's going on with that deal?
Sure thing. So basically, AT&T, before, they just completed the big DirectTV $49 billion acquisition, and they took on a lot of debt to do it. And so previously management said that their goal was to bring down their debt levels and strengthen their balance sheet and get their credit rating back up to the A range, because now it's triple B plus. But apparently they reversed course, and now they're looking to buy a TimeWarner in a 50-50 debt stock deal that it's going to add about $65 billion overall to their debt levels. But I can see the logic of why they'd want to do it, because as we all know, cord cutting is the big thing they're dealing with right now, and their content is king. And so, with them both offering, cable TV and trying to push people towards DirectTV, they figure that this is a good way to get an extra $1 billion in synergies, and that should help make this deal within the next 3 or 4 years or so increase their free cash flow by about $5 billion. So
per year?
Per year, yes. So That would be but about $25 billion from the current 16.7. So that's quite a substantial increase.
Well, tell me this: why? So they just tell me about what did they get out of the DirectTV deal? Just because some people obviously listening are going to know everything about AT&T, but I want to make sure people get a good picture for what they're trying to do, because AT&T is traditionally they're the pipeline. They're kind of like the delivery system for content, and they're worried about the whole idea of becoming like the dumb pipe, where all they are is they get people from point A to point B, but they can't benefit from what they're moving back and forth to people. But buying DirectTV, that gave them access to a lot of content, correct?
Well, yeah. So DirectTV, they had the NFL Sunday Ticket. That was an exclusive for them. So they just that was like a big thing, because live sports is one of those areas where you can't really cut the cord, since it's exclusive to the distribution system itself. And so they benefited from that. And basically the thing that they remember with telecoms like AT&T is the reason that they're such reliable dividend payers is that the free cash flows they generate are very steady. But the problem is that maintaining that infrastructure and then competing on things like expanding 4G LTE, and now we got 5G coming up, which could be, really a huge game changer for everybody involved, that's going to be crazy expensive. AT&T, they ended up spending $18.2 billion on some spectrum that is part of the reason why they got the credit downgrade from S&P in the first place. And that's just for the spectrum. That's not even counting the cost. And what
does that mean by on the spectrum?
Well, basically, it's the frequencies that they send the data over. And so you need a lot of those frequencies, and the thing is, like with 4G, that there's a lot of different. Now the frequencies are called bands. There's about 43 bands so far in use around the world and climbing. And with 5G, it's actually going to be even more fragmented because 5G, we call it the new standard, but it's not actually a single standard. It's going to be really just kind of a collection of different ways of moving data over the air. And so it's a huge opportunity, but they know that, both AT&T and Verizon are going to be basically going to war over this and trying to roll out 5G just across the country. I mean, that's going to be tens of billions of dollars. And so, the same thing with, as I said in my article, AT&T is trying to, diversify and find growth where it can into things like, the Mexican wireless market. And that's a smart thing because Mexico, it's faster growing economy. It's a great growth opportunity. But the problem is that all wireless is very capital intensive. So even if they manage to get a strong foothold and gain market share in Mexico and then say push on into other areas of Central America and Latin America, it's still going to be monstrously expensive. And so DirectTV, because it's satellite, I mean, it's not cheap to launch and maintain satellites, but compared to maintaining, a far larger network on the ground, it's less capital intensive. And so the free cash flow margin is higher. And so by diversifying to that, I mean, DirectTV was a big free cash flow cow. So that's going to increase their free cash flow per share. And once they squeeze the last of the synergies out of that, it's going to really help them out. And then TimeWarner, because it's a content producer, I mean, the capital intensivity of that is so much less. And so that's going to really boost their free cash flow margins even more. And so it's in essence, they're trying to, diversify and find areas of growth where it's, they can scale up without having to just spend a fortune all the time.
Well, tell me this. So the next big thing in terms of capital intensive outlay will be expansion into 5G. But if after this Time Warner deal, AT&T has debt loads in excess of $60 billion and their credit rating is below where they want it to be, I wonder if how that will impact their 5G expansion, because there is all the free cash flow brought on by DirectTV and hopefully Time Warner, but it sounds like that free cash flow may take a few years to actually open up. Is that correct, or am I misunderstanding?
Yeah, that was one of the things I actually wrote another article looking specifically at, how the deal would make sense if it had been all. I initially thought it would be all stock deal just because their debt load was so high and they previously said they wanted to lower it. Now their total debt's going to rise to about $192 billion. And it's, their leverage ratio is going to be about 3.15. So it's not dangerously high, but compared to where it was about 1.5 a few years ago, I mean, that's quite substantially higher. And so that's the thing is when I initially bought AT&T and when I first started writing about the company, I love the yield. 5.3% is awesome. And, they just raised their dividend for the 33rd straight year. So, I mean, that's a fantastic, dividend aristocrat. But the problem is that since 2009, they've only been raising it by 1 cent per quarter per year. And so that's about 2%. So pretty much just keeping up with inflation. And so, when I ran my dividend models, I looked at it and said, well, once they get the DirectTV debt down and the free cash flow opens up to about $20 billion a year by 2020, they should be able to raise that up to, basically double the rate of the dividend growth, and maybe even get it up to 5%. And so, they say, 5% yield plus 5% dividend growth. Well, that's about a 10% total return. And with, on a risk adjusted basis, it's absolutely phenomenal.
Sure.
And so that's essentially the investment thesis I was going with. And so that was my big concern is now, they're piling on so much debt. And, from a earnings perspective and a free cash flow perspective, yes, the deal will immediately be accretive. But as you said, it's like even by 2020, if they're generating $25 billion a year in free cash flow, a lot of that's going to have to come down to paying down their debt, especially since they had their debt maturities if you look at it, I think over the next 3 or 4 years, they have around $25 billion in debt coming due. So, I mean, a lot of that's going to have to be refinanced. And as you pointed out, if they end up going to just, BB credit rating because of this, and if interest rates do end up going up over the coming years, that would be a concern. Now, in terms of the actual safety of the dividend, I know I've seen some articles on Seeking Alpha where people, and some comments especially where people are just like, I got to sell because, I did it for the safety of the dividend and now it's not safe. And I want to assure your listeners, that's not an issue. I mean, management gets, they respect and honor that 33-year growth streak, and they're not going to do anything to, mess that up or put the dividend in danger. But basically, rather than, from what I have to look at is basically my thesis of, well, it's going to be another 3 years where we get these token dividend increases. And then after that, we really start to take off. Now it might be, instead of 3 years, it might be 5 or 6 years, because we got to really take this debt down to a more manageable level after this big acquisition.
Do you like the acquisition of TimeWarner? Do you hope it works out?
Well, I mean, I can understand it from a strategic point of view, and certainly, I mean, I'm all for diversifying your cash flows into less capital-intensive areas. And so, I mean, the brands that we're getting are, very strong, and I personally like them, and there's a lot of growth potential, especially with the assuming Warner can figure out how to get their DC comic universe, rolled out with like Justice League movies and so on, especially growing in India and China where those kind of movies are very popular. It could be, it could be huge. I mean, now AT&T is going to be second only to Disney in terms of, quality premium content. So I like that. And as a long-term investor with, a time horizon of over 10 years, I'm willing to be patient and, take those token increases. The only concern I would have is, from what some critics are saying of the deal, they're kind of, something like Morningstar questioning the capital allocation plan, is that, they're saying management seems to be almost a bit desperate and just grabbing for any kind of growth. And so the thing I would be looking forward is, assuming this thing, the deal closes and we get the synergies and we pay down the debt, are we actually going to start to see that faster dividend growth, or is management then going to say, okay, well, we've paid off half the Time Warner debt, now let's buy 21st Century Fox, and then after that,
right,
let's buy Netflix. And it's, it's like it's kind of like right now AT&T has kind of adopted a Netflix / Amazon model where, there's always a new world to conquer, and we're going to put off, we're not going to focus so much on, the dividend growth now, but just be patient and wait. And, once we've bought up all the content on earth, then, it's like, and pay down the debt, then the free cash flow will be enough that we'll be able to really start kicking it. And it's just like, I'm patient enough to wait that out, but I'm not sure how long regular investors might be willing to hold out on that.
Do you feel that's a real concern, or because it seems like the 21st Century purchase and the Time Warner intended purchase, like you said, I get the strategy because they're looking at where the market's going and they want to make sure that, again, they're not just the dumb pipe, but they're actually benefiting from the pipe themselves. So that makes sense. And yeah, I get your point. I'm wondering are you really concerned management will get content hungry like that, or do you think they're just merely covering bases at this point?
Well, I mean, that's the thing is, anytime you own a company, you have to look at the management, ultimately say, do I trust management to know what they're doing? And, are they going to try to just light money on fire by just throwing money around and overpaying for things? And so that's an understandable risk. But in terms of this, looking at it, I think, it's immediately accretive. It is going to help us once we pay down that debt. And like I said, the brands we're getting, HBO, Cinemax, I mean, it does make sense. Now, of course, with like some of the regulatory concerns, some of the stuff I've read is, well, AT&T might decide to not count, say, if you were a AT&T customer and you were streaming CNN on your smartphone, they might not count that against your data cap, and that that might run into net neutrality regulatory issues, and that's one of the things I've seen about people saying, well, regulators might kill the deal because of the concerns for that. Now, personally, I don't think the deal's going to fall through. I think that all they have to essentially, the big concern that, regulators might have is, well, all of this content, CNN, Turner, TNT, HBO, Cinemax, CW, and as well, is like if you decide we're going to make this exclusive to, DirectTV, then essentially they might look at that as on antitrust grounds that they don't want to see that. Now, personally, I think that kind of concern is ridiculous because the reason they're buying Time Warner is that, hey, look at all this free cash flow we've got coming in from this, and look at all the sales, and it's a great way of diversifying it, and it's been growing faster than we've been growing organically. And so why would you want to kill that? That's like saying, what if AT&T would buy Netflix and then say, hey, we're going to make sure that, essentially you have to subscribe to DirectTV in order to get Netflix content. Well, they would essentially, it'd kill the golden goose, and it would kill the very reason you want it in the first place.
Do you see any other major concerns regulatory wise?
Not really. I mean,
because I know there's been mentions of like antitrust concerns, which I think you kind of just addressed a little bit, and so you sound like that probably alone is not enough to ruin the deal.
Well, I mean, there are some concerns in terms of people have pointed out analogies to when Comcast bought NBC Universal, and that there was similar things about that with net neutrality and what are you going to do with this content. And so Comcast they put in some strange requirements for them to do, like lay fiber optic cable to underserved communities that normally can't afford it. And, Comcast kind of reneged on that. Well, agreed to it initially and then kind of skirted around it. And so, there is some concern the regulators might, take a harder line on it. And then you've got things like, Trump coming out saying, I'm against this. This is dangerous overregulation. And if I'm elected, I'll kill this deal. And then Clinton similarly saying, oh, we're going to have to take a very hard look at it. But, I mean, when you hear politicians like that talking, especially in front of an election, you just have to remember that, hey, that's just how this game is played. They're going to come out, they're going to make all these promises. And in fact, it's like Congress is likely to remain gridlocked. We're not really going to get much changes. And so it's going to be more or less business as usual. So from that perspective and looking at it as objectively as I can, I don't really see it because like AT&T said, this is vertical integration. This is not them trying to buy more cable companies, or buy Dish Network and actually gain a monopoly over something. It's content. They're going to keep distributing it.
So in summary, it sounds like you like the deal. You get the strategy. Maybe you would have liked to have seen a more of a stock deal and less cash to avoid debt levels, but you still like it. You see the benefit. It's going to probably push out bigger dividend increases a little further down the road than you initially thought. But the free cash flow created by this should be a big win for AT&T. And in terms of regulatory speaking, you really don't expect you expect the deal to go through. And as a shareholder, you're happy about that.
Yeah. And I would actually mention that is like I really like how they did structure it, because had they done it all stock, when I ran the numbers, it would have actually essentially guaranteed that we can't, it would have actually been negative in terms of free cash flow per share. So in essence, if they tried to do this thing in all cash by borrowing $86 billion to do it, that would essentially, that's just way too much debt. If you do it all with no debt and all stock, it's too much dilution. So 50-50 is actually a pretty good mix that we're doing here.
Great. Well, Adam, thanks so much for joining us today. This the down low on the deal has been really helpful. Thank you.
All right. Thank you.
Hope you enjoyed the interview today with Adam, the Dividend Sensei. Remember, you can get full show notes with links and other details at investorandthefamily.com. Don't forget to subscribe to the show at iTunes, Stitcher, or the Google Play Store. And if you want to join me on the path to becoming an intelligent investor, simply text the word JOIN FAMILY. That's one word, JOIN FAMILY, to the number 44222, or visit investorandthefamily.com and sign up. We'll make sure to take care of you so you don't miss a thing. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.